This is Power Breakfast on CNBC TV 18. The key macro data that came by on Friday post-markets was India's GDP. In the second quarter, it slowed down to its lowest levels in the last 9 months. The growth stands at 7.1%, which is below the 7.4% estimate that a CNBC TV 18 poll threw up. In addition to that, the fiscal deficit data for October 2 came in and shows that the centre has breached the full-year target in just the first 7 months. Lata Venkatesh is here with more on this data. Lata, what do you make of these data points?
Well, first the positives. Even at 7.1, you can claim you're the fastest running economy in the world. But yes, ours is a base smaller than the comparables like China. The disappointment is from what was estimated. You know, look at the base. Year ago, it was 6.3. Over a 6.3, you should have done a 7.4, 7.5. So the disappointment is, despite having a base, it's only 7.1. Within that, the positives were agriculture. 3.8 was not terribly a worry, and nor was manufacturing at 7.4. The worry was services. Within services, there is this trade, hotels, transport, communication, which are all, you know, your Udupi hotels and your wayside, handicraft makers. That has grown only at 6.8, which is a bit of a worry. But even worse is finance. You know, the finance problems hits only after September end, September 20th. In spite of it, finance, real estate, insurance, etc., have hit only 6.3. That's also a major worry. Government has done reasonably well at about 10.9 or something. Government services, they're called public administration. If you looked at GDP from the expenditure side, then consumption has let us down. It's only about 7% higher, but the bright spark is investment. Gross fixed capital formation has risen by about 12.5%, which is a very, very big positive. One hopes that, gross fixed capital formation forms 30% of the total and consumption forms 55%. So it hits harder when consumption is slower. But all told, at least there is a hope for the future. Speaking of hope for the future, if the government has already spent more than it should have in the first 7 months, then capex is likely to suffer. It's always the case that you hit the deficit earlier, but you normally hit it by December. And then the big advance taxes come only in the fourth quarter, and then you're able to balance budget with a little bit of cut in capex. Now that we have breached it as early as October, chances are capex will have to be cut. So that one motor of investment is not available for the economy. And we know that the debt problems and the auto slowdown, the festive season slowdown of October, and look at the car sales in November, nothing to write home about, which means third quarter might be a bit of a washout. And the fourth quarter already has a very big base, and everybody was expecting the data to come in below 7% anyways. So it looks like the second half is going to have an average less than 7%, in which case we may finish the year just barely touching 7. The positive is, of course, it will get revised next year and the year after and 5 years later and 10 years later. For the moment, it's negative.
Okay, Lata, thank you so much for joining us with that perspective. So a bit of disappointing data coming on the macro picture, both as far as fiscal deficit is concerned as well as the Q2 GDP. But from one expert to others, let's go across to some experts on the opinion regarding the disappointing GDP data that we saw on Friday.
Most important positive is that if you look at capital formation, fixed capital formation, that is now recovering as a percentage of GDP. We are now, we've crossed 30%. I'm talking about either the second quarter or the, if you will, H1, first half. We are over 31, so not yet gone back to earlier peaks, but we are now on the recovery side. My guess is that we will probably get, if you look at the second half, we'll probably get to just about 7% or maybe even a little below 7% in terms of real GDP growth for the year as a whole.
First thing that regarding the base effect, I think if you strip out the base effect, the growth rate in second quarter is actually dipped below 7%. So that's the first point. The second point, that if you look into core GVA, which is excluding the agricultural part and the public part, that has actually now expanded at 6.6%. So that's an number which has slowed down significantly from 8.6% last quarter. So that's, I think, the lowest since Q2 of FY18. There is an element of rural distress because deflator, the agricultural deflator is negative, and it is for the first time in June 2017 that the deflator has turned negative. So I think apart from the slowdown in the core GVA, I think the rural sector data doesn't look promising.
construction, public administration and electricity were known to be buoyant, and that has been the case. However, I think services, if we actually compare it to the high frequency data that we have been getting for at least the September quarter, we were not really seeing that kind of a slag. And unfortunately, we have seen a significant slowdown in the numbers. Private consumption could get a little bit of fillip towards the end of FY19, running into the first quarter of FY20. And that is where we could get a support. But having said that, I think I would be worried on the second half of this year's growth. And overall, we have an estimate of 7.3% GDP, which could possibly see a little bit of downside.
All right, so that was the discussion on GDP, but from the lag indicator of economic growth, we move on to the lead indicator of economic growth, which is auto sales. But before that, we take a short break. Up next, auto companies report muted sales for the month of November. More of that when we return. Keep it with Power Breakfast.